It's 12:30. Welcome everybody to the last of 4 weeks of daily presentations. This week, as some of you know from previous presentations, we're looking at various alternatives and saving one of the best for last, NB Private Equity, combines the diversification benefits that a traditional private equity fund of funds brings with the information and control advantages of a direct private equity investor by adopting a co-investment strategy that allows, and Paul will come on to talk about this, allows the manager to cherry pick from many private equity managers' deal flow. And NB also, in common with some of its peers, pays a dividend from capital, which is 3% of net asset value, with the substantial discount that NB and its peer group trade on. That equates to a dividend yield, I think, of 4.6%. Also, it moves around a bit day to day, but it's a pretty attractive yield for what is essentially a growth asset class. And so with that brief intro, I'll just say that I know plenty of you have attended more than one of these presentations, so you'll know the drill, but there is a Q&A box. You can type questions into that, and there'll be about 30 minutes of Paul presenting and then 15 minutes for us to go through some of those questions at the end. So Paul, with that, over to you.
Great. Thank you very much, Alan. So Paul Daggett, a Managing Director with Neuberger Berman, and I'm going to talk about NB Private Equity Partners. So to start off with, I'll just explain what we do and how we are different to other listed private equity trusts. So we invest directly into private companies, and we do that alongside private equity managers in their core areas of expertise. What we mean by that is we invest through co-investments. A co-investment is a direct investment into a company alongside a lead private equity fund. And so most private equity investments by institutional investors are made through limited partnerships into commingled funds where you invest into a portfolio of that manager's companies. A co-investment, we directly invest into those companies. We look at the company, we due diligence it, we make a decision as to whether we want to invest, and if we do, we directly invest into that particular single company, and we build a portfolio of those within NBPE. We think there's a number of advantages to the approach, which are listed in the bottom left of this slide. There's 5 of them, as you can see. And first of all, Alan mentioned diversification. By co-investing, we can diversify across sectors, underlying private equity managers, company sizes, geographies, and of course, because we're co-investing, we can choose how we do that and when we do that. We're focused on the best opportunities, of course, and what that means is that there is an extra layer of due diligence. So in each co-investment, we have a very thorough due diligence process, and we decide what we think are the best opportunities across the deal flow that we see, and we can control that investment decision. We can also, in that similar way, we say we're dynamic. What we mean by that is we don't invest through large unfunded commitments to funds. We actually choose when to invest and when not to invest, which means we can respond to market conditions. We can slow down our pace when we think that's appropriate. Equally, when we have the opportunity and we think it's appropriate, we can speed up our pace. Number 4 there is ESG due diligence. For Neuberger Berman as a whole and our private equity group, ESG is very important. There's an extra layer of due diligence for every co-investment we look at. So once again, we can make that assessment of each company that we look at from an ESG perspective. And finally, fee efficiency. I think almost 98% of the investments within NBPE's direct equity portfolio, there's a single layer of fees in that there is not a management fee or a carried interest paid to the underlying general partner that we invest alongside. So it's a very fee-efficient way to approach the asset class. Neuberger Berman is a privately owned investment manager. Within private equity, we manage $110 billion of commitments. And there's a lot of numbers on this page. But in the bottom right, you see the pie chart of the different types of investments that we manage, 110 billion in total in private equity, of which 36 billion is in private funds. That's really important because although MBPE doesn't any longer invest into private funds, it invests through co-investments that you see in the top right. And one of the ways we generate those co-investment opportunities is through having very deep private fund relationships. You can see on the left that we have about 280 private equity manager relationships in the asset class. We have a large team, over 200 people in 10 offices globally. So once again, we can gather very deep deal flow. And in the top right-hand side of the page, you see that last year in 2022, we saw 566 co-investment opportunities from 319 different private equity managers. So again, we can be really selective from that. We invest on our private equity platform where we're investing for institutional investors, commingled funds, and of course MBPE. We can choose what we think are the best opportunities, which is a small minority of the total opportunities that we see. Our long-term performance has been good. We've been listed since 2007. You can see on the left-hand side of the page, looking at our net asset value total return, this is in dollars, compared to the MSCI World Index. You can see the outperformance over 3, 5, and 10 years, with only 1 year being a number that maybe we would prefer to be a little bit higher. And of course, it's been a difficult year for markets as a whole. And that was driven, in our case, really by a decline in public market holdings that we have, which were private companies once that were taken public, and we continued to own in 2022. On the share price total return on the right, though, again, you can see over 3, 5, and 10 years the outperformance against the FTSE All-Share Index, this time in sterling. So once again, we're quite proud of the long-term track record we've generated, both in terms of the returns we've generated and also the share price performance that has resulted from that. Quickly on private equity, I'm sure many of you are familiar with some of the advantages of the asset class. First of all, diversification is one thing we've talked about from an NBPE perspective, but just looking at the asset class as a whole, you see in the bar in the bottom, this is from the Bain report that recently came out, fewer than 15% of companies with revenues over $100 million are publicly held. So again, if you look on the left-hand side of the page, you'll see that the number of US listed companies has continued to fall over the long term, whereas private equity owned companies, the numbers have increased significantly. And so what this is telling you is you can access companies that are very difficult to access through public markets, mostly smaller companies than you'll see in public markets. But then also the other advantage is on the right-hand side of the page, which really, I think, revolves around active ownership. Of course, there's advantages to the way that private equity can due diligence opportunities, the level of information they can get for each deal they look at. But private equity managers during the hold period have the advantage of being control owners. They can change and control management and hold them accountable. They can really drive value creation through M&A and through organic growth. And of course, they can also have a very long-term focus. They don't have to focus on quarterly earnings, which obviously public market companies need to report. And then finally, on the sell side, you can choose when you actually choose to exit. So obviously you look to exit into a strong market for the particular type of company you own, and you can choose that timing. And of course, 2022, the second half of it, was a slower year for private equity, whereas 2021 was a very busy year. And again, you'll see that in our numbers when we come to those pages. So moving on to MBPE's strategy. Again, a lot going on the page. If you start on the left-hand side, we really invest around 2 key themes. Certainly that has been our focus for quite a number of years at this point. And that is companies that have what we think are long-term secular growth trends that should drive the market in which the company operates, or I should say, companies where we think there'll be lower expected cyclicality. These are companies that generally are in more defensive sectors or end markets, or at least have a business model that we think is somewhat defensive. So the company is positioned with the current portfolio in these two key areas. And we've done that through bottoms-up portfolio construction that you see in the middle of the page. What we mean by that is that we look at each opportunity with our investment committee. We make a fundamental decision around that particular company. Much of that is driven by the company specifics, as well as whether this is the right private equity fund for the right opportunity. If we choose to include it in the portfolio, we do monitor from the top down by sector, but really drive the portfolio construction from what we think are the best opportunities. And then on the right, you'll see some of the key sector themes that we have: software, consumer and e-commerce, industrials, industrial technology, and healthcare, all being examples of sectors you'll see well represented in our current portfolio. So coming back to the subject of diversification and starting on the right-hand side of the page, this looks at the direct equity portfolio, which is 92% of our portfolio at this point in time. We have a total portfolio of $1.4 billion. The direct equity portfolio is 92 companies alongside 56 different private equity managers. But the way we think about diversification is better illustrated by the pie chart. You see the names in about half of the portfolio of positions of $25 million or above, and there's 17 of those. Of course, there's a lot of other companies in the portfolio as well, but what we're really trying to illustrate here is that we try to build a portfolio that is adequately diversified, but equally not over-diversified to the extent that a single company can't really drive or help to drive the returns of the fund. So the biggest position today is a company called Action, which is about 5% of the portfolio. But as you can see, if you take, say, the top 20, that makes up about half of the portfolio in total. So diversification, really important, something we think carefully about. And then the last number from the right-hand side that I'll mention, and we'll come back to this, the average holding period of the companies in the portfolio at this point in time is 4.3 years. And private equity holding periods over time have typically been 3 to 5 years. And so we're in a position where we have companies that have been owned for some time, are maturing, and hopefully that will be a good place for the portfolio to be as the market continues to develop. Within both geography and industry, on the top of the page, you can see that the portfolio is predominantly North America at the moment. It is the biggest private equity market, and so we are slightly overweight relative to other markets, but not significantly so, actually. 73% of the portfolio in North America and 23% in Europe today, with a small representation from Asia. And then in terms of sector, I mentioned that we do monitor this. We look to make sure that we are reasonably well balanced. And you can see that the two biggest sectors today are consumer and e-commerce and tech, media, and telecom. I think important to note that each of these sectors is itself well diversified by the underlying companies within these. And again, for the most part, the companies within these sectors fit those two underlying themes that I mentioned earlier around companies with secular growth drivers or companies that we think have a reason to be somewhat less cyclical. So even in the consumer and e-commerce sector, those two things apply. And again, I can talk about some examples in a few slides. So on slide 10, the top 10 companies, these are just the private positions. We also do have some public positions, which aren't included on this slide. So the top 10 private companies make up about 1/3 of the fair value of the fund as a whole. Again, diversification comes across. You can see the different holding periods in that second column from the left, the investment date. You see the different sectors, 6 different high-level sectors mentioned here. 10 different sponsors. So again, talking about co-investing and co-investing alongside the right partners, we think all of these are very high quality private equity funds, and importantly that we're investing alongside those funds in their areas of expertise. Now, some of these companies, the main growth driver is organic growth. Action would be the best example of that. Action, a company you may know, it's owned and managed by 3i. It had a very strong year for growth last year, with revenue and EBITDA growing very significantly. And the same store sales part of the business was one driver of that, with like-for-like sales up about 18% last year. But they also opened 280 new stores across Europe. And so that organic growth was both on the same store basis, but also rolling out that concept across different countries in Europe, which really drove organic growth for that company. And it has been really a very strong performer over a long period of time for 3i and since 2020 for MBPE's portfolio. You'll also see, though, a lot of growth by M&A. And in some cases, like 4 companies down, you see USI, which is an insurance brokerage roll-up strategy in the US alongside KKR. So this is taking a fragmented industry and looking to really grow it through M&A of small acquisitions over time. And that has been an incremental grower through that M&A roll-up strategy since MBPE has been a partner with KKR, which has been almost 6 years at this point. And then the other type of M&A can be a little bit more transformational with very large acquisitions. MHS is a good example of that, halfway down the page. This is alongside a US buyout firm called THL. It's in the industrial space, but really industrial technology, and it produces software and systems that are used in package sorting centers. So when you think about e-commerce as a secular growth driver, MHS is producing the systems and some of the equipment that really help to drive that through the package sorting centers. And this is a company that made a very significant add-on in Europe last year. So looking to grow geographically to continue to transform the business through significant rifle shot type of M&A. So really all kinds of growth represented on this page. But most importantly, again, you can see all of the diversification metrics that we have. And by the way, most of this valuation information on the page is now as of the fourth quarter. About 3/4 of our private companies' valuations have already been updated to year-end valuations at this point in time. So moving on to liquidity, by which we mean exits and cash back to MBPE. You can see on the bar chart on the left-hand side of this page that the average liquidity level for the portfolio has been about 19% of the beginning of year fair value of the fund. And so in this case, we're at about $1.4 billion of portfolio fair value. The average over 5 years has been 19% of that. As I mentioned, 2021 was a particularly strong year for the market and for MBPE. 2022 was a market which was particularly in the second half of the year slower than 2021. Nevertheless, we still had $143 million of proceeds, which came from 7 full and partial exits, as well as some sell down of that public stock that we still own that I mentioned earlier. And then other portfolio realizations, small partial realizations, dividends, interest, etc. All of that totaled to $143 million of cash back to the fund during the year. And in the bottom right-hand side of the page, again, I mentioned the maturity profile of the companies in the fund with that average of 4.3 year holding period that we have. Again, you can see by vintage year, really 2017, 18, 19, 20 are all very big components of the portfolio and at different levels of maturity and private equity sense. And again, the market has been slower, but important to note the private equity market is still active. We are still seeing good deal flow on the co-investment side. And I would hope that private equity will still be open as an exit opportunity for companies in our portfolio over time. We do pay a dividend, and we do have a strong capital position. So starting with the capital position, we have over $300 million of pro forma liquidity. Most of that comes in the form of our credit facility, which is a $300 million credit facility that runs until 2029. That gives us a lot of room to make new investments should we choose to. But I think more importantly than that, it gives us a lot of flexibility around other capital needs that we may have over time. And as I mentioned earlier, we can start and stop investing when we choose to. And so we had a slower year for new investments last year because we expected a lower level of liquidity. And so we slowed down our investment pace. We made 2 new investments last year. Thus far this year, we haven't made any new investments to date. Again, we can invest when we choose to, but we can also choose to be cautious and prudent with the balance sheet. And that really has been the approach we've taken over the last 12 months. On the front side, on the dividend side of things, we pay a dividend twice yearly. We just paid in February 47 cents a share, which is in line with the last 2 dividends that we paid in 2022. Again, our dividend is set at 3% of NAV or greater. And again, as Alan mentioned earlier, the dividend yield on the share price, this was the end of February share price, was 4.7%. It's actually at this point just over 5%, because the discount has widened a little bit over the last 3 weeks. And with that, really the conclusion, we do think we have a differentiated strategy in that we invest through co-investments. That gives us all of the advantages that I mentioned at the beginning, that we can be selective, we can be dynamic with our pace, and really that focus on fee efficiency through predominantly a single layer of fees in the portfolio. The long-term performance, again, particularly over 3, 5, and 10 years, proud of our performance in a NAV sense, but also in terms of the share price performance. And then that positioning, that we think we're well positioned. We have a portfolio that is 107% invested, so more than fully invested, but with over $300 million of pro forma available liquidity. And again, we've got a well-diversified and maturing portfolio, but equally we are positioned to be flexible in this market. We're continuing to see strong deal flow from the NB private equity platform. And as and when the time is right, we can, of course, choose to participate in that deal flow. So with that, I will finish my presentation, and I'm happy to answer any questions that have come in.
Thanks, Paul. And as you and I agreed just before we came on, the discount and valuations is well, it is a hot topic in the investment trust sector, and let's not get into anyone else's valuations, but listed private equity as a group and NBPE as a company trading on significant discount. And I suppose if you come from the starting point that the discount is the stock market's opinion of the valuation, then there's I guess there's a number of bullet points on that to go through as to why maybe the stock market is being too bearish. And we can talk about your approach and private equity's approach to valuing companies and how it's changed over the years. Perhaps 20 years ago it was okay to make a very close correlation, and then we can also talk about diversification and how your portfolio doesn't really look like a stock market index in terms of sectors and companies. And then I suppose the other common stock market kind of negative point is, well, the IPO market's closed, so how are you going to actually prove these valuations? And perhaps you can talk a little bit about historically where exits have come from, and where and how well funded the private equity industry is to keep deal flow moving.
Yes. So a lot of questions, a lot of good questions wrapped up into
But
one.
but fundamentally, it's all why you want a 40% discount.
Yeah.
And
Yeah. So, well, look, I'll start off with just how valuations work in private equity, which is that um, private equity valuations valued by the underlying funds, um, generally, with a very thorough valuation process that involves public market comparables, very often private equity recent transaction comparables, and sometimes DCF, discounted cash flow. But I think the most important input usually is public market comparables, very often with a discount for liquidity built into that valuation. So the valuations happen on a quarterly basis. As I mentioned, we're receiving our fourth quarter valuations at this point in time. About three-quarters of our private portfolio is valued as of December in the numbers we've been talking about. And of those numbers, so in that three-quarters sample set, the private valuations actually increased by about 4% over the calendar year 2022. So, I think in our sense, the underlying portfolio appears to be performing well, and valuations have held up. Actually, if you look at the first 9 months of 2022, the average multiple, so EV to EBITDA multiple that we were holding companies at, actually decreased by almost a turn, yet those valuations increased slightly on a constant currency basis. So what that tells you is it's not the valuation multiple alone, it's the fact that earnings have been growing that is also important to that valuation and has been a positive over the first 9 months. And we'll get those numbers out for the fourth quarter in April. So to come back to your question, agreed. The discounts we're seeing in private equity, including MBPE, where our discount is, I think in the high 30s percent, 38, 39%. I think one of the big factors is private valuations. I should have mentioned fourth quarter valuations, of course, are audited, and our auditor is KPMG. So that report will be out in April. But I think, again, obviously the operating metrics, how companies are performing, as well as the valuation levels, will be important to investors to see. For those who work in private equity, I think there's very good transparency into how valuations work, both on an aggregate basis, but also company by company. But I think it takes time, particularly in a down market, for investors to monitor portfolios to understand the direction of travel and whether evaluations are fair. And I would hope that over time that confidence returns. But it certainly has been an input into that discount. But again, as I mentioned, our performance has been very, very good over the long term. The private valuations that we've received so far have held up really well in 2022, and it's really been the publics that have been a slight drag on our returns over that last 12-month period.
And what do you think the climate for exits looks like at the moment? Obviously, as I said, the IPO market's shut, but that's really not your only route out, isn't it? So how do you see M&A and the other routes to exit going at the moment?
Yeah, so really three routes as we think about it. One is IPO, one is trade sales, and one is private equity. And of course, private equity to private equity transactions are quite common in today's market. So I think you're right, IPOs closed, and who knows when that will be an opportunity again. Trade sales, I think, are possible, but much less likely. in a market with this type of volatility and uncertainty. I think private equity, though, as I mentioned, is still active. We are still seeing the funds that we invest in on our platform, not MBPE, but we've seen a lot of activity, ongoing activity. And in terms of new co-investments, we see significant activity. And where those private equity funds are buying from has tended to be other private equity firms. We've also seen a trend of public to privates. But the point is, the deals we are seeing getting done, a large proportion of those are coming from private equity. And the fact that we own 92 companies maturing in terms of the whole period and hopefully performing well should mean that private equity can be an exit route for us in 2022. I think that is the most viable exit route and the most likely for our portfolio during 2023.
Mm. And historically, how much of your performance comes from the the multiple you get at exit versus how you've taken uplifts through valuation?
Yeah, so I think it depends on the year. Not surprisingly, again, 2021, the uplift was larger than average. But over the 5-year period, the uplift has been almost 40% on exits. Again, that is a big part of that is 2021. So more typically, I think in the 20 to 30% range. But when you think about private equity returns, that uplift is a meaningful part of returns, but is not it's mostly not where the returns come from. And so again, valuations have become more dynamic over time, both upwards and downwards. And I think what you see is as companies are performing, if you take a case where a company is performing and performing to plan, then if you have, say, a 3 to 4 year hold period, what you'll typically see is quarter on quarter an increase in the value of the company driven hopefully by earnings. And all of this means that if you have a 3 to 4 year hold period, the majority of the valuation increases come during the holding period of the investment. But you do get very often that uptick at the end, that so-called uplift. So I'm not saying the uplift isn't important, but actually we think that we can continue to produce returns without a significant amount of exits. That is not exits that we look to produce the majority of our returns. So it's important, but it's not everything within the return case for private equity.
Mm, mm, mm. Just going on to gearing. Again, thinking about stock market coming to conclusions which result in discount. In the last big down cycle in the financial crisis, you had a very different set of private equity trusts that used a fund of private equity trusts that got themselves into some trouble with being overcommitted. Do you want to just talk a little bit about how you gear and how your strategy kind of has an advantage that you're not required to run an overcommitment strategy compared to a fund of funds? I think it's quite an important point, really, isn't it? That may be lost on some investors.
Yeah, no, it's definitely an important point, and something when I mentioned us being able to control our investment pace, is obviously part of that decision. So very often funds invest through commitments to underlying funds, and those are legal commitments that get called down over time, and of course also distribute capital back over time. But in a market that is slowing, if you're concerned about liquidity coming back, you can't slow your pace of investing if you have invested through commitments to underlying funds. Whereas what we do is we invest at this point directly in co-investments. We look at each opportunity that is offered to us through the NB platform, and we can say yes or no. And in a market where we don't know what the realization pace is going to be, we can, of course, just choose to stop investing for a period of time with no negative consequence of doing that, except, of course, we're not making new investments. But there's no reason for us to invest in a less certain market. So really, I think it gives us that ability to control our capital outflows. We are 107% invested, as I mentioned, so we're at a level where we think we're efficient with the balance sheet, but because we don't have these large unfunded commitments and just over 300 million of liquidity, we think we're in a good position with the balance sheet, and it's something we, as you say, Alan, I think if you go back to the GFC, that is where there's at least a couple of examples of funds running into trouble, and something we're very mindful of.
Mm, mm, mm. And so there's a number of questions which I think we can probably title interest rates discuss. And on obviously the first point is interest rates have gone up. Private equity relies on debt. What does that mean? But also we obviously have a great deal of nervousness in the banking sector in Europe and the US at the moment. And somebody's noted Credit Suisse is a lender to private equity. What does that specifically mean? But I think there's a kind of wider picture, isn't there, that interest rates and lending. What does that mean for your sector?
Yeah. So to start off with, I should have made this clear earlier, but we invest in leveraged buyouts, and the vast majority of our portfolio are profitable companies, cash flow positive on an EBITDA basis. So we are investing in companies that generate cash flows to support leverage. What we're not doing is a very small minority of the portfolio is in what I would call venture or growth investments. The vast majority is in profitable buyout positions. So to come back to interest rates, with that background, yes, interest rates obviously have increased significantly. LBOs typically, at least certainly in the US, based on floating rate debt. Now that can, of course, be hedged, and in some cases there is a component of fixed rate interest, but for the most part, it's floating rate debt. So as interest rates increase, of course, that increases the cost of servicing that for underlying companies. So it's something I'd say, we're seeing both in new deals and the existing portfolio. It will, of course, have an effect on returns, and it's something that we look at carefully in the portfolio. But ultimately, again, we feel that the portfolio is well positioned and has the ability to service the debt that it has in hand. And I think there's two aspects to that. One is what I mentioned, which is what it will do to returns. And I think for companies that are performing according to their plan and they're growing, then that impact on returns is relatively small. It's again still important as something to watch, but relatively small. And then of course there's also just the question on leverage as a whole, and the levels of leverage within the fund. Our average at the end of September was 6 times EV to EBITDA. which actually had increased over the 9 months before. Most of the reason for that was M&A. As companies buy new businesses, then very often they'll fund that with debt. But again, we think that for the mix of industries that we have within the portfolio, that level of debt is pretty reasonable. And again, we do have 20% of the portfolio, for example, in software and technology, which generally will have higher levels of debt in private equity senses. So the number's an average, but we think it's at a reasonable level.
Mm. And my recollection from the GFC was PE was running 8 to 10 times EBITDA, so the industry's a little bit more conservative, even after low interest rates.
Yeah, I think that's right. And of course, there's the industry, and then there's what we select from the co-investment flow that we see. So every investment we've made has been something we've selected. And again, as I mentioned, for quite a long period of time, we've been trying to invest around these two core themes, and really all of this came around in sort of 2017, 18, 19, certainly prior to COVID, that we tried to position the portfolio to be ready for a downturn. Obviously, not expecting COVID and everything that's followed it, but thinking that we've been in an economic expansion for 10 years and we should position the portfolio appropriately. And of course, looking at the capital structure of a company is one of the most important aspects of that decision. So something we've been thinking about for a long time. I think you might be on mute, Alan.
That leads me on to the last question, which is about the companies themselves, and you have this pipeline of 500 or 600 deals, and you select. You obviously filter that. Do you want to talk a little bit about what your criteria are, and what kind of sectors have served you well that you favour, and also there's a question about you obviously have other funds that may participate in deals. You want to just sort of briefly touch on allocation policies
Yeah.
for how that works?
Yeah, so we have an investment committee that makes all of the investment decisions for co-investments and primary funds for all of our private equity mandates, both on the private side and NBPE. And that's an underwriting decision that the investment committee makes about a particular deal. Again, I think over time, the sectors you see in NBPE are areas that we have been focused on, not surprisingly. Software and technology, healthcare, business services, financial services, but not balance sheet financial services. These are all areas that are well represented within NBPE's portfolio. And I think at the moment we're really focused on companies that can perform in an unpredictable economy. So resilient business models would, I say, be the biggest focus across those different sectors. The way allocations work, very simply, is on a pro rata basis, according to what each mandate would ideally choose to invest. And so each mandate has a number. If it wants to participate in a particular investment that has been approved by the investment committee, that amount is then allocated on a pro rata basis according to that demand. So it's really something which is taken very seriously, overseen by our legal department, but could be summarized very simply as a pro rata allocation policy.
Yeah, and what's the process for managing? Not all of your funds are kind of captive money, if you like. You're not working with mandates that have to sell when NBP doesn't have to sell, are you? There's no kind of pressure.
No, I mean The funds are all managed independently. Most of the capital we manage is in limited partnership form. So it doesn't recycle, makes new investments over some particular period of time and then sells when the lead private equity firm chooses to sell. So that's important on the sell side, that usually it's not our decision, it's the decision of the lead private equity firm who, when we've gone into a deal, we view as an expert in that particular sector and for that particular company. And so them choosing when to sell is appropriate. And whenever that lead fund sells, then the whole position, all of the co-investments we have will be sold alongside that private equity firm. So the sell decision isn't something that we really generally sort of run within our process. That is run by the private equity manager we invest alongside for the most part.
Yeah, yeah. I see that we've used our allocated time very efficiently, 1 minute over. So, Paul, thanks so much. I think we've actually done a reasonable job of dealing with most of the questions. If there are other questions, please do drop us at Kepler a line. And also, as I say every day, our own website has plenty of information on NBPE and other things. And of course, the company has its own excellent website, and a lot of work goes into producing things like report and accounts. So please do refer to those as well. And with that, Paul, good to see you, and we'll see you on the next one.
Yeah. Thank you very much. Thank you, everyone.